Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, August 14th, 2015. In this video, I want to take a look at the energy sector and share my thoughts as to where I think the energy stocks are most likely headed. And I'm talking from a longer, intermediate term to longer term perspective. So we're looking out, several months throughout the remainder of the year and likely into 2016. So this is more of a macro call than a micro call, if you will. We're starting out here looking at XLE, the Energy Spider Select Energy Sector ETF, and this is a chart that I've pointed out recently a few times on the site. This is a very long-term chart going all the way back to 1999, so we have a good 15 plus, 16 plus years of trading history on XLE to look at. Couple things to mention. This is the trend line that I've pointed out here. This is the do or die, our primary bull market uptrend line generated off the 2002 lows. You can see we had numerous tags back here in 02 and 03. Came down during a bear market in energy stocks, which ended in early 09. And then most recently, we've broken below that trend line. And as I stated on the site, I pointed this out earlier this month, this is a monthly chart. Therefore, we need to really what happens intra-month, in other words, till the end of August doesn't matter too much. It's where prices close. So if we have a solid close below this primary uptrend line, more than likely we're going to visit this. This is my ultimate downside goal, or target, I should say, in XLE, and that is right around the $62 area. We'll zoom in on that in a minute on the weekly chart. So again, the energy stocks are at a critical juncture from a technical point of view, and they certainly have the ability to post a strong rally in a month's end and close back above that this primary uptrend line. But we'll dig down in the charts in a minute, and I'll share my thoughts as to where I think we're going. But before we leave this chart, what we're looking at here, the history on the energy stocks. If you look at these orange trend lines here, this was just I'd put almost as much stock into this trend line as this lower one. We had actually more reactions on this trend line here than we did on this trend line, at least in recent years. I'm talking about this lower orange uptrend line. If you stop it here, I know it continues, but right here at the apex, this formed a symmetrical triangle pattern. I believe that was pointed out in the past on the site. We had this pretty well-defined downtrend line, which prices broke out of on XLE back in early 2013, and went on to rally pretty strongly from there. Now, one potentially bearish development is that pattern fell well short of where it would have projected. If you take a look at a symmetrical triangle pattern, such as the orange one we have here, and you measure the widest point of the pattern, which I did with this white trend line, let's pull prices down here. That pattern, the technical projection on it would have taken XLE all the way up to, about the $180 level. And so from just eyeballing this chart, prices fell well short of that. You could call that a bull trap, if you will, but I won't go that far because that rally lasted for quite some period of time. Again, the energy stocks broke out in early 13. So we had, that was January of 13, and they didn't top until mid-2014. So it was about an 18-month rally. So decent move in the energy stocks. But nonetheless, we can see, how impulsively it failed at that point. Now, if this were a 60-minute or a daily chart, I probably would call that a fake out or a false breakout. But then again, once again, there's too many candlesticks there, too long a time period. And most importantly, where we are today is prices came down, hit the bottom. If I extend the bottom of that line that I had on the triangle pattern, rode above it for a while, then broke below. That was, bearish warning number one. Moved quickly down to this key downtrend line. We were saved by the bell last month. We closed pretty much right on that trend line at the end of July, and so far we're trading above it and have been all month. So net bearish price action in XLE. I mean, no doubt we're really at the in a confirmed downtrend and have been. So again, from the glass half full perspective, there is a shot that it can regain that level. If and when it does, and I'll probably start taking a serious look at some of the energy stocks for long trade candidates. But until then, it's taking long positions here would be highly speculative and really going against the grain of TA. I'm talking from a longer term perspective for those of you looking to invest in the energy sector. I know there's some attractive dividend yields and all that, but in trading 101 is you buy support, sell broken support or breaks of support, and that's what we have here. So you have something trading just under key support, and again, this would be my longer term downside target. Excuse me. This ROC 12, this does a great job of defining bull and bear markets, especially in the broad market. Just jump over to the SPY for a second. We'll look at do it with the SPY or the SPX, and you can see here how well, when the ROC 12 is above the zero level, that confirms bull markets. So look at this great bull run back in the 90s. Every bit of it was above. The ROC 12 was positive, and then pretty early on in the great bear market, the ROC 12 went negative. So this is just a great tool. As I said, I use it primarily on the broad markets, but the energy sector is a large component of the broad market, so it works pretty well there as well. But you take a look at that if you can. You could replicate that on your chart. Most importantly, I use that ROC 12 on a monthly basis, not a weekly. It tends to be where it works best, defining the secular trends, the secular bull and bear markets. So getting back to that, my point here is this, that we have, oops, wrong stock, there's XOM. Let's go back to XLE. And as you can see, the ROC 12 is clearly in a confirmed bear market, confirming that the energy sector is in a bear market and is yet to even reverse. The most recent bar was longer than the previous bar, so we haven't even seen this begin to turn up. And of course, by the time it does cross back into positive territory, it'll be safe to say that the worst is over in the energy stocks. But we're far from that yet. Another thing to note is the RSI. Usually works good on most time frames, especially long term. We didn't quite get to the 30 oversold level here, but we got very close back then in looks like early 02. Launch of that great bull market there. We hit it looked like we just tagged the oversold level. It came very close back at the bottom. If you look where the crosshairs go up, catches that candlestick back in late March, or the candlestick that finalized at the end of March in 09, which marked the beginning of this bull market. So we're getting there, but we're not quite there yet. We're only at 37. So ideally, where I'm going with this video is my preferred scenario on the energy stocks is that we are going to see more downside, that the bear market in energy stocks is not over. I know recently I made a case that we may hold this line, and that if that proves to be the case, then my analysis will change. But as of now, over time, I'm favoring a continued move lower, which would what does that correlate to? About let's see if I can measure it out here roughly. Another 10% or so drop, give or take, in the energy sector. And doing so would bring us both down to this horizontal support level, as well as at or close to oversold readings on the monthly RSI. Another thing to look at down here on the bottom for long term, I like to use a PPO in lieu of the MACD. And what we need to see is a bullish crossover. As you can see, the orange line is still well below the white line, or the 9 EMA on the PPO. So we had a bullish crossover back here early on in the beginning of this bull market. We had a bearish crossover here, although it went flat, and that was a whipsaw signal, crossed back over about this point. So this was, according to the PPO, on a sell signal. And although it turned out to be a whipsaw signal, the downside wasn't much because it crossed back over here. Then it stayed flat. Just a side note, on a PPO or MACD, when you're looking at bullish and bearish crossovers, with the signal line, when it's flat like this, I stay away from it. It's when you get this separation like this, like we have here, like we had back here, like we currently have, and you get a crossover, those are usually good signals. So we had, the orange line was well below. We had a bullish crossover right around this point here, and that led to a strong uptrend. It's been lines were trading flat for a while, so a little indiscernible, but now we clearly have separation. So again, three things we want to see: ROC 12 in positive territory, or at least turning up, oversold reading on the RSI. Now if we get the oversold reading and the move down to there, the ROC 12 will still be well in red territory, so that's not going to give us, this is more of a confirmation that a new uptrend has started. But if you want to, for those of you that like to catch bottoms and tops as I do, this is where I would be buying, looking to buy at this $60-ish range, 62-ish, 61. I'll zoom in on that in a minute, and the RSI down oversold, and looking at a ideally confirmation once we get a bullish crossover on the PPO on the monthly time frame. Okay, let's just move forward. Look at the weekly time frame. Okay, here's that level. You can see this is a 10-year weekly chart, so 10 years of price history. Each candlestick represents 1 week trading action. You know, on the monthly chart we were just looking at, each candlestick was 1 month of trading action. So we see numerous reactions going back here. We have a reaction there, prices pulled back, finally broke above it, came back to back test. And, on a weekly chart, you don't have to have a perfect kiss. This is close enough to consider that a reaction off that level or a range. I could put another parallel trend line there, but you get the point. So this is what defines this support level now. We have numerous reactions from above. Once prices broke below it, you had an impulsive move lower, which helps validate that trend line was support at the time. Prices came back up, kiss. A few attempts to break through, failed. Finally had the impetus to get up there and break on through, and did that. Came back down and essentially backtest. And you might say, well, look, that went, prices fell well below it. But if you look at it, this was only 2 weeks, and it was a very sharp move back above. So that was just a whipsaw signal, and it actually caught what is now, or what did form to be an uptrend line after that. This is a pretty well-defined uptrend line. So again, reaction, and then this uptrend line, finally prices broke down impulsively, backtest, and that was, pretty much put us in or led to the confirmed bear market that we're in the energy stocks. So again, just eyeballing this chart, this is a great support level. It also lines up with that monthly support level I was looking at. And to clarify, yeah, that's right around the $62 area. As most of you know, I really like to see, especially on the daily and weekly time frames, I like to see positive divergence in place before a trend reversal, and we don't have that here. You can see the RSI is making a lower low than it did back here. The PPO, although there's the potential for small divergence from this point to this point, you can see the PPO is still heading quite a bit lower. It's pointing down. So although anything's possible, again, if we do regain that monthly trend line, so far, the action recently in the last week or so has been somewhat bullish. You can see this nice candlestick here forming. But again, there's a lot of work to be done. And I think even barring a small rally, I see some pretty significant resistance up here. If the energy stocks were to rally up to about anywhere from the $72 to the $74 area, I think they're going to find resistance there. And so I could see a little bounce that might last a couple more weeks, and more than likely a move back down to this level. Okay, and we're just going to take a look at 2 stocks in this video besides XLE. As I often say, if you want to know where a sector is going, all you have to do is take a look and figure out where the components are going. And I should say that tongue-in-cheek. It's easier said than done. But with that being said, ExxonMobil is the 800-pound gorilla in the room. That's the undisputed heavyweight champ of the energy sector, with a market cap, at least at the figures I'm looking at, about almost 330 billion. The next largest component being Chevron at about 163 billion. CVX. Being the next largest. And so let's take a look at where ExxonMobil is going. And this is one reason that I'm a little bit more bearish on the energy stocks at this point in time. I do see what looks to be more downside on XOM, especially from a longer term perspective. Again, here I'm not talking days, weeks. I'm talking a more of a macro call over the next few months and probably into 2016, quite likely. This is a support level. This is a weekly chart we're looking at. Not the most clear chart, in my opinion. I don't have a lot of trend lines. I do see some support. I see a reaction here, a reaction low right there. This tested from below. There was a reaction, I should say a reaction from above, below, and some reactions back here, quite a bit. So I do think that's a decent support level, although not the best defined level that I've seen, right around 70. I'm having a hard time putting the crosshairs on there. Actually, all I'll have to do is this, and it will tell me 74.20-ish, give or take. Again, I like to see bullish divergences, not even close right now. The RSI, we are really stretched and oversold on the weekly. So there's, again, this sort of fits into my scenario. I could see a bounce in the near term. And what that would do is if it took us up a little bit and then we came back down and hit this support level, that has a potential to put in bullish divergences. In other words, the RSI, which is currently oversold, on a little bounce would move higher, probably put in a higher low, and same thing with the PPO. But right now we don't have any divergence, either current or potential, forming on the weekly chart of ExxonMobil. Back here in the 2010 lows, we did have a nice divergent low, as you can see on the RSI and the PPO. So that's ExxonMobil. Now the monthly chart speaks much louder to me than the weekly chart, or even especially the daily chart, which is quite messy to me. So we're looking here at a monthly chart. Now this goes all the way back to 1984. So this is really a secular bull market in ExxonMobil, and I had it in this well-defined price channel, this ascending price channel, which was defined by, I had a parallel set of trend lines only because there were several reaction lows, and sometimes we had a pierce below. So I put about equal stock. And when I do this, if I have parallel trend lines, uptrend or downtrend lines, especially let's talk on the uptrend lines, it's a break of the lower trend line that you really want to wait for. And what happened with ExxonMobil was odd. There was sort of some quirky behavior. We did break down back here and went down pretty impulsively. You can see the candlestick if we zoom in, some impulsive selling that helped validate that lower trend line. But then prices whipped back up, and which has just been indicative of this market in the last few years. That's a false sell signal or a whipsaw signal. We kind of rode along some sloppy action, kind of trading around that channel, but have since turned lower. And again, now looking at this chart, even though we're looking at a long-term monthly time frame, if this was on a 60-minute, a daily time frame, my thoughts would be no different. What I see here is pretty much a breakdown, call it a back test, if you will, riding up the bottom of that channel, and now prices turning lower. This is a very nice support level here. It comes in around 56.20, and then below that we have an even roughly equal support level as far as validity, about 44.28, 44.30. So I think these are two valid levels, and my expectation is that ExxonMobil, again, the leader of the energy sector, is over time, and over time being months, probably into 2016, we'll come down and see this level, and that's roughly, again, we're looking at a monthly frame, so don't hold me to the penny, but about 56.20, and if and when that level goes, which I do see as a possibility, then that would take us all the way down to 44.28. Right now, the stock's trading at 78.38, so that's quite a bit move lower. What supports that, other than that long-term channel breakdown, back tests, and prices finally rolling over? Well, that's first and foremost, and then confirmation down here. There's that ROC 12. Again, you look at the bull and bear markets; it's done a really nice job of defining it. This may not look like much. I measured that out. If I'm not mistaken, that was nearly a 20% drop right there. So that was a bear market back then, in the early 2000s, and this was obviously a bear market here, and that one was over 20%. I forget the numbers. And again, the ROC 12 is confirming that we are in a bear market in XOM. And we also had a divergent high. I haven't drawn it out here, which I'll do right now, but if we look at from these earlier peaks back in 2007, 2008, all the way up to the most recent highs, take this line, we can see divergent high. At least from this point here, we see divergence on that ROC 12. We see long-standing divergence on the RSI and the PPO as well. So that's it. We had prices rising up in this rising channel, putting in a divergent high, and finally a breakdown. So just putting this chart, scaling it in perspective, I would see easily a move down to here or here over time. And again, being a monthly chart, that's going to take a while to get there. So obviously, I'm not very optimistic on ExxonMobil in the long term. But again, we'll watch and see what the energy stocks, how they close this month. Okay, the second largest component, and by the way, ExxonMobil and Chevron make up, let me see. Okay, I just checked it on the Spider's website. Exxon and Chevron together make up over 28% of the XLE. So over 1/4 of the returns of the XLE, which is the energy sector ETF, are solely attributed to these two stocks, and that's why I'm only going to talk on these two. So we're about wrapping this up. This is a chart I pointed out numerous times, for a couple of years. And I was calling for a big bear market in CVX, and we got that. And this was one of the longest standing shorts on the site. And way back, somewhere back here, before this most recent wedge broke, I mentioned this being my ultimate target, which is this downside trend line. So again, this trend line comes all the way back to 1980, the beginning of 1985, January of 85. So this is a secular bull market uptrend line, CVX, and we are here now. So I mentioned this may be a good time. It's certainly objective to go long CVX here. Keep in mind too, ExxonMobil could have its own unique set of fundamental issues that over the next coming months or years, ExxonMobil drops, gives up that over or nearly double market cap exposure. So we could see ExxonMobil drop and the rest of the energy stocks or the bulk of them hold up and do well. So CVX, it's possible, could catch support here. The energy sector can hold on, and maybe ExxonMobil itself goes down. So again, from simply a pure perspective of buying support, you could do that here if you were a long-term investor. Now you'd have to have some patience, because if you'd have to wait. Your signal, if you're buying support on a monthly chart, will be a close or break a monthly close, I should say, below this long-term uptrend line, and that could take a while to happen. But either way, there is the possibility, and this is what I wanted to mention, that this trend line can break. It doesn't, just because it is a trend line and we've found support each and every time, and that was my expectation up here, is that we would revisit this trend line, which we now have done. Doesn't mean that we're going to bounce and then move on, and this what we're talking 30-year bull market is going to just continue forever. So if and when that breaks, and that would put us in a new secular bear market, or confirm that we are in a new secular bear market in Chevron. So something to watch, and I have some support. These aren't my official targets, but around 67, and then there's some really good support. I would think if that line broke, and this might take a year more to get there, I would say that Chevron's going down to this line here, which I have called just under around the $55 area. So something to watch for. Now, as pointed out before, these were rising wedge patterns, these orange lines, and when we broke down, we had a breakdown, a back test, and that was confirmed by negative divergence on the ROC12, which is confirming, of course, we're in a bear market now. We had a strong divergent high on the as well with the RSI 14, the PPO. So everything in my book, and I was harping on this one for a while, everything in the charts indicated that Chevron was due for a bear market back up here, and that's exactly what we had. And now the million-dollar question, is that enough? Certainly, by just looking at this wedge, that is enough, and I could see prices hanging in there, going up at least for a few weeks, maybe months, and possibly years. But again, if that trend line breaks and gives way on a monthly basis, then we're going to see in the coming months, possibly years, some more downside in Chevron. Okay, and we'll wrap this video up. Just zoom into a weekly chart on Chevron. I don't have a lot on this weekly chart. It's a 10-year price history. I do see some support here where this horizontal line is. If you notice to the left of the chart, these volume at price histograms usually do a good job of identifying key support levels. So you look at the bars here, and then down here you have the much larger bars. So this is where this drop off here, and it might be hard to make out on the YouTube video. I'm referring to the green and red horizontal bars, the histogram coming off the left of the chart. So there, as well as numerous reactions. If you really look close, look at all the reactions that came on that trend line from above and below, quite a few. So, and then when we finally broke above, that's bullish, came back, 1-2 back test, and now most recently we've broken below there. So this is a little bearish right now. We're trading, below that volume price histogram bar. We're trading below the horizontal line that I put on top of there, which shows that support, as well as confirmed by all the reactions I just showed. And Chevron broke below, and it's back testing from below. So personally, I would be a little adverse to taking Chevron Texaco here, even though we're on that monthly trend line, until or unless that prices came back over. This could be a temporary overshoot. You know, often when we see these sharp moves, whether they're up or down, this was a very impulsive move. I refer to this as the momentum will help often cause support or resistance level to become overshot temporarily, where prices go through where it might have normally found support if we came down at a more moderate pace. In this case, we shot through and it may, you know, slingshot back up, but it hasn't yet. So you have to be careful there. If you buy Chevron Texaco now, you are buying on long-term monthly support. So if you're an investor looking for dividend stocks, sure, you could do that, but you might want to keep your stops. You can, at the very most, you want to wait for a monthly close below that monthly trend line. But on a weekly basis, if you wanted to keep things a little tighter, I would set a stop below last week's lows, which are 82.89. I'm holding the crosshairs on last week's candle. I think if we take that out, things might get a little ugly in Chevron. So also, as I mentioned, I like to see divergence, at least on a weekly time frame. We don't have anything remotely close to bullish divergence yet. We are oversold. There's one little case to be made, but as I often state, oversold in itself is not a buy indicator. Oversold with other things confirming can be, but right now the PPO is pointed straight down. The RSI is pretty much, it's coming off oversold levels, but we still haven't even crossed back above the 30 level. That would be a first potential trigger, but ideally, and it will take probably a few months to get there, you want to see some weekly divergence here, bullish divergence. In other words, prices come back down, move a little lower, and put in bullish divergence. So that's my take on the energy sector. As I said, we'll watch XLE here and see how we close out the month, and I'll try to update this video at that time. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.